It's 7:18 a.m. Your coffee is still too hot to drink, your calendar is already stacked, and your phone is already trying to hijack your day. A headline flashes, AI stocks surge again. Another one. The Fed might cut rates. Or not. Your group chat is loud. Somebody's posting an option screenshot like it's a trophy. And a friend you respect just texted, "Are you buying this dip?" And right there, before your first meeting, you feel it. That itch. That feeling that you should be doing something. That you're falling behind. That if you don't act now, you'll miss the move that changes everything. But here's the uncomfortable question most people never ask themselves. If you don't have time to analyze, why are you trying to invest like someone who does? Because in Benjamin Graham's world, there are two identities, two lanes, two games. And if you drive in the wrong lane, it's not just your returns that crash, your peace does too. In the next few minutes, I'm going to give you a simple identity test you can answer in 2 sentences. If you answer honestly, you'll know what kind of investor you actually are, what kind of portfolio fits your real life, and how to stop turning your long-term plan into a daily emotional negotiation. And there's one tiny habit busy professionals dow without realizing it that quietly destroys compounding. Not because it looks risky, but because it looks responsible. We'll get to it. And once you see it, you can't unsee it. Let's start with the truth. Graham built his philosophy on: the stock market is not a place to prove your intelligence. It's a place to expose your temperament. Most people lose money not because they're stupid, but because they're busy. And they're emotionally unprotected. They want professional results with amateur routines. They want enterprising returns with defensive effort. And the market loves people like that, because the market always has a salesman. Graham gave him a name, Mr. Market. Mr. Market is the loudest person in the room. He knocks on your door every day. Sometimes he's euphoric. Sometimes he's depressed. Sometimes he's terrified. And every day he offers you a price, not a truth. A price. And if you don't have a clear identity, you treat his moods like instructions. Now here's where Graham gets misunderstood. People hear defensive investor and they think it means timid, weak, settling, missing out. But Graham didn't mean defensive like fearful. He meant defensive like a bridge engineer. A bridge engineer doesn't guess how much weight the bridge will hold. They build it to hold far more than it should ever need to. They assume storms. They assume mistakes. They assume stress. That's margin of safety. And for a busy professional, margin of safety is not just a concept for stocks. It's a philosophy for life. Because your life already has enough uncertainty. Your job, your health, your family, your time, your energy. So why would you build your investing plan on the one thing you have the least of attention? Graham's framework is brutally honest. If you want to be an enterprising investor, you earn that right with work, not with hope, not with vibes, not with being into finance. Work, time, study, independent judgment, the ability to stay rational when the crowd is not. The enterprising investor does more than own a portfolio. They run a process. They analyze businesses. They read financial statements. They think in probabilities. They demand a margin of safety on individual decisions, and they do it consistently, not when they feel inspired, not only when markets are calm, consistently. Now look at your real life. You have a full-time job. Maybe you're building a career. Maybe you're raising kids. Maybe you're handling debt, a mortgage, a business, a side hustle, aging parents, or all of it at once. You can't spend 10 hours a week reading 10K forms, learning accounting, comparing competitive moats, and stress testing cash flows. So if you don't have time for enterprising level analysis. You don't just lack an edge, you lack the safety net. And that's the point. The enterprising lane is not dangerous because analysis is bad. It's dangerous because pretending is expensive. Pretending turns investing into speculation. And speculation is not evil, Graham said, but confusing it with investing is. Here's the identity fork in plain language. A defensive investor wants results that come from sound habits, not heroic insights. Defensive investor accepts that the market is unpredictable and designs a plan that doesn't require prediction. A defensive investor says, I don't need to be brilliant. I need to be durable. An enterprising investor says, I will earn extra returns by doing extra work, and I will pay the emotional price of being different. Now listen carefully, because this next sentence may save you years. The biggest risk for busy professionals is not market volatility, it's identity mismatch. When you're in the wrong lane, every headline becomes a steering wheel. AI is the future. The Magnificent Seven can't be stopped. Rates are higher for longer. Inflation is back. A recession is coming. A soft landing is coming. And because you're busy, you can't verify. You can only react. Reaction feels like control, but reaction is usually just fear wearing a mask. This is why people with great incomes still sabotage their wealth. They contribute to their 401k and then make a few moves in their brokerage account to feel smarter. They open a Roth IRA and then chase whatever is trending on social media because it feels like being proactive. They read a thread, watch a clip, see a chart, and suddenly they're managing their future like a day trader between meetings. They're not investing. They're soothing an emotion. Graham would say, you are letting Mr. Market set your schedule. And if you want to see what this looks like in real life, picture the high-performing professional who's used to competence. Let's call him Alex. Alex is sharp. Alex is disciplined at work. Alex is the person people trust with deadlines and decisions. But in the market, Alex is constantly tired, constantly behind, constantly catching up. So Alex buys what's popular because it feels efficient. A hot AI name, a crypto coin that everyone's talking about, a short-dated options trade because somebody said this is the easiest way to boost returns. At first, it works. Of course, it works. Mr. Market loves to reward impatience just long enough to create faith. Then it doesn't. A news cycle flips. Volatility spikes. A position gaps down. The options expire worthless. The crypto chart turns into a staircase down. And Alex doesn't just lose money, Alex loses trust in his own judgment. He becomes more active to fix it, which creates more mistakes, which creates more activity. That loop doesn't just drain a portfolio, it drains a person. This is why the defensive identity is so powerful for busy professionals. It breaks the loop. It replaces improvisation with a plan you can actually live with. Now, I promised you a 2-sentence identity test. Here it is. Answer it like your money depends on it, because it does. First sentence. Do I have the time and willingness to analyze businesses' deeply financial statements, competitive position, balance sheet strength, and update that analysis with discipline? Second sentence. When I'm wrong, and the price drops, and headlines get ugly, will I calmly follow my process, or will I start negotiating with myself? If you can't say yes to both sentences, you are not an enterprising investor, and that's not an insult, that's clarity. Because the defensive identity is not lesser, it's more honest. more sustainable, more compatible with real life. And honesty is a margin of safety. Most people don't fail because they choose the defensive path. They fail because they refuse to choose. They want to be defensive when markets fall and enterprising when markets rise. They want safety and thrill at the same time. That's not a strategy. That's a personality conflict. So let's resolve it. If you're a busy professional, the defensive approach is not just safer. It's how you stop paying the market tuition every year. Because here's the hidden cost of chasing enterprising thrills without enterprising time. It drains your attention. It drains your confidence. It drains your patience. And it turns compounding into a shaky relationship where you check your portfolio like it's a heart monitor. You know this feeling. You're at work and you're doing fine until the market drops 2% in a day. Then you feel it in your chest. You refresh an app, you scroll, you search, you just want to know what's going on. And suddenly your mind is not in your life anymore. It's in a price. That is not freedom. That is a subscription to anxiety. Now here's what Graham would remind you. You are not obligated to be active. You are obligated to be rational. The market offers you prices. It does not demand actions. So the defensive investor builds a system that makes action rare and discipline automatic. Let's talk about that system. For a modern defensive investor, especially a busy professional, the simplest, most Graham-aligned approach is built on 4 pillars: diversification, low costs, appropriate asset allocation, a schedule that protects you from yourself. Notice what's not on that list. Prediction. No one can consistently predict what the Fed will do, where interest rates will go next quarter, whether inflation will cool faster than expected, or whether the next year will be a bull market or a bear market. Even the people who sound confident are usually just narrating the past, and the market punishes people who confuse narratives with knowledge. So instead of trying to be right about the next move, the defensive investor tries to be unbreakable across many moves. This is why Graham used the phrase adequate return, not maximum return. Adequate. Because adequate, compounded for decades, changes a life. Adequate lets you sleep. Adequate keeps you from reaching for leverage, margin, and fragile bets just to feel like you're doing more. Adequate keeps your plan inside the boundaries of human behavior. That's what most people really need. A plan that matches reality, not fantasy. That's why broad, low-cost index funds and ETFs became such a powerful tool for defensive investors. Not because they're exciting, but because they remove the need to be a full-time analyst. A defensive investor can use diversified exposure like a total stock market index fund or an S&P 500 index fund paired with high-quality bond exposure depending on risk tolerance and time horizon. And yes, bonds matter for defensive investors not because they always perform, but because they stabilize behavior. They reduce the odds that you panic at the worst time. This is temperament engineering. Graham understood that your plan is only as good as your ability to stick to it. He even suggested boundaries. Don't go all in on stocks or all in on bonds. He spoke about keeping a meaningful balance, often describing a range where stocks might be as low as 25% or as high as 75%, depending on conditions and temperament. Not as a market timing trick, as a discipline tool, a way to avoid extremes when emotions are loud. For you, that becomes a simple question. What allocation can I hold through a 30% drop without changing my personality? Because that's the real test. It's easy to call yourself long-term when prices are rising. The market doesn't test you on green days. It tests you on red ones. Now let's make this practical for the American busy professional life. If you have a 401k, your defensive superpower is automation. Most people treat their 401k like a background tab. They set it and forget it until panic forces them to remember it. Instead, do this. Pick a diversified set of low-cost funds your plan often a broad U.S. stock index, maybe an international index, and a bond fund or a single low-cost target date fund if simplicity helps you stay consistent. Then automate your contribution rate. Then automate increases when you get raises. Then stop watching it daily. That's not laziness. That's defensive intelligence. If you have a Roth IRA, your defensive advantage is consistency. Choose a simple, diversified ETF or index fund approach you understand. Contribute regularly. Let time do the heavy lifting. If you have a taxable brokerage account, your defensive advantage is restraint, because taxable accounts punish overactivity with taxes and mistakes. Long-term capital gains reward patience. Short-term churn feeds Uncle Sam and Mr. Market at the same time. And now we arrive at the part most people don't want to hear because it ruins the fantasy. The market does not care that you're busy. It does not give extra returns for effort squeezed between meetings. It rewards the right process, executed consistently over time. So if you choose the defensive identity, you choose a different form of pride. You stop trying to look smart. You start trying to stay safe. And that safety becomes a platform for growth. Now let's talk about what busy professionals really struggle with. Not the plan itself, but the noise. Because the modern market is a noise machine. There's always a theme. AI, crypto, biotech, electric vehicles, meme stocks, rate cuts, rate hikes, soft landing, hard landing, election cycles. There's always a villain and a hero. There's always a chart designed to make you feel like you're missing the train. And Mr. Market uses that noise to sell you urgency. Here's the defensive investor oath. Say it like you mean it. I don't have to act. I have to decide. I don't have to predict. I have to prepare. I don't have to chase. I have to compound. If you repeat that enough, you will start noticing something strange. The biggest battles in investing happen before you ever buy a stock. They happen in your identity. They happen in your temperament. They happen when nobody is watching. Now, remember the habit I told you about, the one that quietly destroys compounding? Let's name it. It's not picking the wrong ETF. It's not even buying the top. It's the habit that looks harmless, even responsible. Constant monitoring, checking prices all day, refreshing your portfolio like it's your pulse. Because every time you check, you invite Mr. Market into your mind. And the human brain is not built to see volatile prices and stay calm. If you check your portfolio 10 times a day, you are not becoming informed. You are becoming conditioned. You are training yourself to react. And once you're trained to react, you will eventually act at the wrong time. This is how intelligent, high-achieving people end up selling near bottoms. Not because they don't know better, but because they rehearsed the fear all week. They stared at the numbers until the numbers felt like reality. But a price is not reality. A price is an opinion. A business is reality. Your long-term plan is reality. So the defensive investor changes one thing that changes everything. They schedule their attention. Here's what that looks like daily. You don't need to check. The market will do what it does. Weekly. Maybe a quick glance if you must, 5 minutes, not 50. Monthly. Confirm contributions happened. That's it. Quarterly. A short review. Rebalance if needed. Check allocation drift. Confirm fees are low. Confirm you still understand what you own. Annually, a deeper review. Tax planning if applicable. Contribution limits. Beneficiaries. Insurance. Emergency fund. The whole margin of safety picture. And here's another Graham-style truth that modern investing culture rarely says out loud. For most people, the biggest lever is not the stock you pick. It's the behavior you repeat, your savings rate, your consistency, your ability to keep buying when it's boring and keep holding when it's scary. A defensive investor doesn't just build a portfolio with a margin of safety. They build a life with a margin of safety. They keep an emergency fund so a layoff doesn't force a market sale. They keep consumer debt from becoming a monthly emergency. They protect their cash flow because cash flow is what keeps you rational when markets aren't. When your life has no margin, every market dip feels like a threat. When your life has margin, market dips become just weather. And that's the point. You want your investing plan to be stronger than your moods. Notice what's missing: reacting to headlines. Because headlines are designed for clicks, not for your retirement. And your retirement is not built by being entertained. It's built by being consistent. Now, some of you are thinking, but what if I want a little excitement? What if I want a little upside? This is where the defensive investor can be wise instead of rigid. If you truly want to scratch the itch, create a sandbox. A small capped portion of your investing money you can afford to lose without changing your life. 5%. 10% at most, depending on your situation. That sandbox is where you can explore themes, learn, make mistakes, study businesses, even try a few individual stocks carefully with humility. But your core portfolio, the part that funds your future, stays defensive. It stays boring. It stays protected. Because boring is not a flaw. Boring is the sound of compounding doing its job. And compounding rarely feels exciting in the moment. It feels like nothing is happening. Until one day you look back and realize the quiet years were the powerful years. Now let's bring Graham back into the room because he would want you to understand the moral of this story. Graham believed investing is most successful when it is most businesslike, not because you need an MBA, but because you need a principle, a rule, a standard that doesn't change when your feelings change. If you are defensive, your standard is simple: diversify broadly. Keep costs low. Avoid extremes. Insist on a margin of safety in your life cash reserves, manageable debt, room for error. And treat Mr. Market like a servant, not a guide. Because the market will offer you fear at a discount and euphoria at a premium. It will beg you to do the wrong thing at the wrong time. And if you're busy, if your attention is scarce, then your greatest advantage is not speed, it's structure. Let's make it painfully clear what structure means for a busy professional. A written plan, even if it's one page. A default portfolio built on diversified, low-cost funds. Automated contributions through your 401k and Roth IRA. A rebalancing schedule. A rule that you do not make portfolio changes based on breaking news. A rule that you never change your strategy during market panic. A rule that when volatility spikes, you reduce inputs, not increase them. Less scrolling, less searching, more sleep. That's defensive. That's intelligent. That's how you protect the downside so the upside has time to surprise you. Now, let's return to that morning scene. It's 7:18 a.m. again. Same coffee, same calendar, same market. The headline flashes, "Markets tumble on recession fears." Your group chat is buzzing. Somebody says, "Sell before it gets worse." Mister, Market knocks on your door with trembling hands and a dramatic voice. And this time, you don't feel the itch, you feel clarity. Because you already chose your lane. You already know who you are. You are not an enterprising investor trying to squeeze analysis into the margins of a busy life. You are a defensive investor building wealth, like a professional builds a career, slowly, consistently, with systems. So you do what the defensive investor does. You let your automatic contributions keep buying. You rebalance on schedule, not on emotion. You remember that volatility is not a signal, it's a fee. The fee you pay for long-term returns, and you pay it calmly because your plan assumed it. You don't need to win every year. You need to survive every year. That's the secret most people never learn until it's too late. In investing, survival is a strategy. Durability is an edge. And the person who keeps their head when others lose theirs doesn't need to be a genius. They need to be disciplined. So if you're busy, if you have a full-time job, if you don't have the time to analyze businesses deeply, choose defensive, not enterprising. Not because you're giving up, but because you're finally aligning your money with your real life. You're finally demanding a margin of safety, not just in your portfolio, but in your identity. And when you do that, something powerful happens. Mr. Market keeps knocking, but you stop opening the door. You stop letting his mood decide your moves. You stop confusing noise with opportunity. You stop renting your piece to the next headline. And you begin to build the kind of wealth that doesn't just look good on a screen. It feels good in your life. If your plan is built on low-cost index funds and ETFs, automated through your 401k and Roth IRA, guided by a simple asset allocation you can actually hold, then you don't need daily genius. You need quiet repetition. And that's a rare kind of power in a world addicted to noise. Let other people chase headlines and hot takes. You build ownership. You build resilience. You build a portfolio you can live with for decades, because the real flex isn't a screenshot, it's stability. That's what these notes are for. Daily reminders to train your mind to invest like a true, intelligent investor. Because the market will always tempt you, but it doesn't have to own you.